Sid, hello.
Hey Tiago, how's it going?
Very well. I've got a jackhammer going on in the background, got a new pool going in, so I'm amazed you can't hear this. Modern technology, eh?
That's very good. I can't hear it.
So, look, lots to talk about. I think last
What are you
time,
getting done to the pool, by the way? Before we go any further?
just a new pool, new year,
Very
new pool.
nice.
You know how it goes.
Ah, as you do, as you do. Are you sort of extending it or getting it deep or making it deeper?
Yeah, this
What's
one you
the?
can't swim in. It's got steps going all the way across it. So I'm going to have a swimming lane that's going to be a bit longer as well. Yeah.
Oh, it's going to have a diving pool as well, like one of those boards. Or no?
No, no diving pool, Sid. No diving pool. Let's keep it
That's for next year,
realistic.
is it?
Yeah, got to have something to look forward to.
Fair enough.
Right, we've
Fair
kind of
enough.
veered off topic a little bit here, Sid.
Have you?
So,
You started it with the jackhammer, so I thought, let's talk about
let's
that.
roll with it, eh? So last time
Okay,
we
cool.
spoke last Friday, Silvergate had gone. And
Yes.
then over the weekend, then Silicon Valley went, and then Signature went.
Yes. So I think that was the order, wasn't it? Silvergate, then Silicon Valley on Friday, and Signature on Sunday.
Yeah,
Something like that.
yeah. So talk us through Silicon Valley then. What happened there?
Well, it's a funny one. I mean, Silicon Valley Bank is quite a large bank. It was 16th largest American bank when it was operational. As the name suggests, it was sort of zeroed in into Silicon Valley, and therefore the VCs and the tech companies used to put their money there. It was just that they were one of the biggest. They had the biggest presence in Silicon Valley, so and they sponsored events and NBA finals and that sort of stuff. So everybody knew if you want a bank in Silicon Valley, that's where you would go, right? So they had a huge. Just a bit of background I'll give you. So what happened was in sort of 2021 and stuff like that, they had a huge frenzy of VC money pouring in and funding and what have you. And that led to a lot of people depositing money into Silicon Valley Bank. So with all this money coming in, and also they had restrictions as well. So if you just if you were a startup and you took a line of credit or debt from Silicon Valley Bank, which was the most easy place to get a loan from, you had to have all your accounts in Silicon Valley Bank as well, just for transparency and what have you. So basically, they forced everybody to join the ecosystem. And this sort of led to them suddenly receiving millions and millions of deposits in 2021, right? And what now do they do with all this money? And I think they decided to be quite conservative in their sort of investing, and they decided to buy the T-bills, the Fed bonds, which at the time were yielding about 1%. No, it's fine because it's fairly secure. It's quite a liquid market, and you can sell those bonds pretty easily. And as long as the interest rates stay flat, it doesn't matter because historically they've been going down. So if you had a bond which was yielding 2% and the interest rate had gone down to 1%, basically that bond was worth twice as much because it was now the old bond was worth twice as much because yielding double the interest rate, giving you twice as much return.
I think I
So
can see where the problem's coming here.
yeah, so it worked really well. I mean, we've seen interest rates drop from the 1980s constantly coming down, 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 down. So holding bonds was an absolute no-brainer. But this all changed. And what happened was Fed suddenly turned hawkish with the inflation and they started quantitative tightening, removed liquidity from the market, and started raising interest rates to 3 to 4%, right? We all know that. And suddenly, all this bond portfolios that these banks had were suddenly worth a lot less than what they had basically bought them at, which is not a problem because they're basically called a hold to maturity portfolio, which means they don't have to sell it. As long as they're getting 1% on this money, it's a non-event. The maturity comes at 10 years and they go knocking on Fed's door and the Fed gives them the money back. And until then, they've been paid 1% and everything is pretty secure. So nothing's wrong with it.
And my understanding is banks are forced by law to buy bonds. Is that right?
Well, I don't know about that exactly, but they need to have some compliance CRR requirements after 2008 fiasco, where they have to have some pristine or high quality liquid assets. I think they're called HQLAs, and they need to be on the balance sheets so that if some issue happens like it did in 2008, they've got some decent quality collateral backing up their sort of operation,
Right.
so to speak.
Okay.
And I think there's no better pristine collateral in the world, allegedly, than the T-bill, or so the Fed thinks anyways. So, I mean, that's basically it's fine. It's not a problem having these bonds. It's actually quite conservative, quite risk averse, so that's good. But what happened was there were unintended consequences, and that always happens, isn't it? You think it's going to go one way, and things start happening elsewhere, which you haven't factored into your calculations. And basically, what happened with the Fed was the Fed raised the rates, thinking, "Oh, that'll cut down inflation because we can't control the supply side. Supplies are drying out, so we'll control the demand. We'll dry out the demand so that people don't ask for more goods." And because everything is expensive to them, and that'll bring the inflation down automatically. But what happened was more trickier. So yes, they did try to control the inflation, which sort of happened. But the biggest issue was that a lot of these companies, with this sort of money had dried up, they started, a lot of these startups, they weren't getting funding cheaply. So they started using up the funding they already had and living off it to pay their operational cost and payroll and what have you. So there was already quite a lot of large withdrawals going on in SVB behind the scenes before anything really happened. So SVB then had to sell these bonds that they held on the portfolio, thinking, okay, so we've got to get the money back to the depositors and we have to sell these bonds. But now these bonds are worth a lot less because the interest rates have gone up to 3-4%, and you've bought these bonds at 1%. So they took a loss selling these bonds to make the depositors whole. And nothing happened until Thursday when they had the quarterly quarterly earnings report. So that was the background so far. So what happened was on Thursday, they had the quarterly earnings report. I bet you the CEO woke up thinking, no big deal. I'm just going to make a statement. Everything's going to be fine. And it's business as usual. And they said we lost 1.8 billion trying to sell these bonds, right? To make our depositors whole. And because we sold them at sort of 70 cents to $1 or something like that. This news was not well received on social media. And the VCs got onto it. And because of the nature of Silicon Valley, I mean, everybody knows everybody. And also they are connected on hyperspeed through social media and other points of contact. So the VC started saying, okay, this doesn't look good. Start withdrawing your money now, right? To all the investors, that the companies they had invested in, the startups they were involved in, or their friends and what have you. And this just became viral run of epic consequences. So everybody started getting the money out. And it's not like the old days, right? Where you sort of go and queue up in a bank and you have to wait for your turn to get your money out.
Yeah.
This is all online now. Everybody logs onto their laptop, moves money to anywhere they possibly can. And the problem most people had was that they couldn't open another bank account fast enough to get their money out of Silicon Valley Bank. So people were transferring it into their personal bank accounts, which you'd never do normally because the regulators will come down like a ton of brick. But if it was to save money, that's what they did. And they got the money out so quickly. And this word of mouth on steroids, really. And that basically meant that the run was just uncontrollable.
The figures were huge, weren't they?
Oh, insane. I mean, think about it. This is the second largest bank failure in history of the US. The first one was Washington Mutual.
Yeah.
And they had like 16 billion withdrawn over 10 days.
Yeah.
Right? And that caused them to shut down in 2008. 40 billion plus was withdrawn in a single day from Silicon Valley Bank.
That's nuts.
Yeah.
That's a bad day.
That's just insane. And basically, this really shut down the shops for Silicon Valley Bank. There was no way they could have managed to make that good.
Yeah. Yeah. Incredible.
I think I was speaking to a couple of people and they're saying they couldn't even log into their accounts afternoon because in the morning, everybody was getting the money out on Friday. And by the afternoon, everything was seized up. You couldn't access your bank account, nothing. Nobody was picking up the phone. You couldn't get to the branches in time. It was all a bit of a shit show.
Yeah. And this is the trend, isn't it, with these bank runs getting quicker and quicker.
Well, exactly. I mean, it's amazing. We remember things happening slowly, right? But all the frictions that have been removed to make banking easier also makes it even more vulnerable, really.
Yeah.
Is the way I look at it.
So that was Silicon Valley Bank, and then Sunday we had Signature. Now, Signature was a bit of an odd one, and still is in many respects, isn't it? So, by all accounts, Signature still had a viable business. My understanding was there wasn't a huge bank run like with the other two banks.
No. Yeah, tell me. Yeah, that was quite interesting, wasn't it?
So the FDIC came in on Sunday and shut them down. Now, I understand that's very unusual procedure for FDIC. Usually when they're going to do that, they come in 5 p.m. on a Friday, go through everything, and try and have the bank sold by Sunday evening before the markets open Monday. But these guys came in on a Sunday and shut it down. Now, what's interesting about this is Barney Frank from Frank Dodd fame. He's a shareholder. He's on the board of directors of Signature Bank. And he's come out and said that Signature Bank had a viable business and they were shut down because of their associations with crypto.
Really?
So, I mean, talk about shadiness. I mean, that is shady.
Oh, so maybe Nick Carter was right with his Operation Choke Point then.
Maybe. Yeah, I mean, that's pretty nuts, right? I mean, if it's proven to be true that they've just gone in and arbitrarily shut down a bank that had a viable business model because they didn't like their customers, their legal customers, that's going to be a huge scandal.
Yeah, but if only we can prove it, right? Can you prove it? That's the problem.
Well, I can't, but
no, as in like not you, but as in like can Signature Bank or shareholders and directors of Signature Bank prove it? Because
well, let's see, right? Because all of this weaves a very tight story between all. We don't really know what's going on in the background, but it's clearly, I'd say, orchestrated.
It looks targeted, yeah.
It looks, between this and Custodia, and so I think if things start coming out with the Custodia case, I wouldn't be surprised if this all starts coming out as well. I hope it does.
Yeah. It's funny, isn't it? 3 weeks ago, when we talked about Custodia Bank and them not getting regulatory approval for their bank, and we thought something's up, what we didn't expect was 3 weeks later, we'll be talking about all the crypto banks have been taken down.
And all the crypto banks, all the major crypto banks in the US to be taken down, and Bitcoin to be up 35%.
I know, that's brilliant, isn't it? I mean, finally, it's showing itself as exactly what it was designed for. 2008 was the last time the banks failed and Bitcoin was conceived. And today it's sort of shown that it definitely is not correlated to the banking industry at all.
Yeah, I mean,
it is in an inverse way.
That was that's beautiful. I mean, it was really nice to see. So I'm excited to see where it goes from here.
Yeah, and that is after the Fed has taken the kneecaps off the crypto industry completely.
Precisely. I mean, wouldn't it be ironic if, Senator Warren, who's probably behind all of this, actually, was responsible for making people finally wake up to Bitcoin? I mean, that would just be beautifully ironic.
Yeah, I think before it happens in the US, I think it'll happen abroad. More so, people will see outside the US, they'll see what's happening with the US markets and the Fed bailouts, and they'll turn to Bitcoin before, I think.
I don't know. I mean, it's just getting so hard to ignore. I mean, we were talking before we started recording about this clip that's doing the rounds with Yellen, and it's just such a cesspool. I don't see how you ignore it for long. But I've been saying that for a while, so maybe you're right.
But the thing is also, I mean, you listen to these people, whether it's the Fed chairman the other day talking about inflation, why is it at 2%, or Secretary Yellen today being asked why is she backstopping every bank, which she thinks is big enough to fail, not big, is too big to fail, versus the small banks. I mean, the answers just don't make sense. Or maybe I'm just too naive.
No, they don't. They don't make sense. So let's talk about that, right? So these banks all failed over the weekend, and then we got the U.S. government's response, right? Which absolutely is not a bailout, for the record. But let's have a look at what this bailout is. So it's officially called the Bank Term Funding Program. And what it allows...
Oh, is that what BTFP is? Because I was reading about it. Everybody said BTFP, and I was like, buy the fucking what?
Buy the fucking print, as I think McCormick said.
Right. I kept trying to put... So that's what it is. Okay, understood. Carry on.
So this applies to credit unions, banks, and what they can do is they can offer up their bonds that have been impaired because, as you pointed out, the prices have all gone down. They can pledge this up to the Fed for up to 1 year, and in exchange, the Fed will give them cash for the par value of those bonds. So I think this is going to have incredible consequences. So first of all, it's a huge bailout for the whole industry, right? This is not just a targeted bailout, despite what they're saying. And in fact, we can see if we look at the discount window. So this shows the bank usage of the Fed's backstop, right? And if we look at the graph of that, you can see it's a complete flat line until we get 2008. Then it goes vertically up, and they took out $111 billion from the Fed in emergency funding. Then it goes straight back down, flat line. We get to 2020 in COVID, and we go up to just under $60 billion. Straight back down. And today we're up at, I think it's $152 billion. So we by far eclipsed 2008, which is crazy. So
do we know what that means?
I think it means this is where the banks are getting all their money from, because they're desperate to get money in order to survive, right? So they're chucking in all their impaired bonds to the Fed, and they're getting all this cash out. So this is a 1 year program, allegedly, right? But we all know there's nothing as permanent as a temporary government program.
Quite.
So this is quite incredible. Now, the problem is, where is this going to lead in terms of incentives, right? So when a bank buys bonds, it's a very straightforward kind of buy for them. There's really not a huge amount to think about. But there is one thing they have to think about. They have to think about interest rates. And they have to hedge, as you've been pointing out, again, when that goes against them. And now what's happening is they don't even need to do that. Literally, they cannot lose now. If rates go down, the value of their bonds go up, they're laughing. And if rates go up, it doesn't matter. The Fed's got them.
Yeah. And I think this 1 year window, as you rightly said, is going to get extended into infinity, isn't it? Perpetuity.
Yeah. So that's going to lead to all sorts of weirdness in the market. And the other big problem, I think, that we're already seeing is that Yellen has come out and said that they're not going to indefinitely backstop non-systemically important banks, i.e. the regional banks.
Yeah.
Why are you going to keep your money there?
Yeah, I think... So what happened was Silicon Valley Bank was that people were moving their money out to any bank that would have it. Any bank. Didn't matter if it was another regional bank, startup, it didn't matter. Just needed to get the money out. So the small regional banks did really well. The community banks, as they call them in the US, they did really well with having these huge inflows coming in on Sunday and Monday. And so not Sunday, sorry, Friday, sorry. And they suddenly were flush with cash. But I don't think so that cash is going to, as you rightly said, is going to stay with them. They're just a bridge onwards. And once people have got the money out, those who did manage to get it out, they'll move it on to bigger banks.
It's going to inevitably lead to concentration of wealth in the big banks, and the lesser important banks will probably end up going out of business.
Yeah.
Now, if we were to put our tinfoil hats on for a minute, you could argue this is a good first step towards a central bank digital currency. Right?
Yeah.
Concentrate all the wealth in 3 or 4 banks and then go from there. You're already going to slowly weed out all these other banks, which will have, let's face it, no business in the world where central bank digital currencies exist.
Yeah, the only thing I keep thinking is, I mean, you've tried to open accounts, I've tried to open accounts for my business and what have you. It is so difficult. If you've got 1 or 2 big banks, they are so difficult to sort of open accounts with and what have you, and do business with them. Whereas that's where the smaller banks, like at least in the UK, the Revoluts, the Starlings, and similarly in the US, they've got similar startups. They were just so nimble on their feet. I mean, they
Yeah.
created easy access to capital, easy access in and out. You could open an account with one day. You didn't need all the regulatory paperwork that the other banks were asking. So I don't think these big banks will be able to move as quickly unless they end up just buying and leaving these smaller banks as under their umbrella but functioning independently.
They won't. But look, if you're in a C-suite in a company and you have a fiduciary duty to your shareholders, would it be neglect keeping money
Yeah,
in a small
no,
bank?
that's a good point. Yeah, no, I'd get that.
Especially as we think, this instability we're seeing is, in the long run, probably only going to get worse, right? As the debt increases and the system becomes more fragile, more volatile, we're just probably going to end up seeing more and more events like this.
Yeah. My friend was saying the other day, we were talking about SVB, and we were saying, it's funny how Fed or the people in FIDIC and places, FDIC, don't see this through beforehand. It's always a knee-jerk reaction on a Friday evening, and a bunch of people get together and say, oh, what do we do now? And they do something like they did this time, backstop and insure everything, even the uninsured, not thinking through what the implications of that are going to be a year down the line or 20 years down the line. They don't care. It's just like, what do we do now? And they're just constantly in firefighting mode, constantly.
Yeah.
Which shows.
You'd like to think these guys are geniuses, right?
That's exactly my point. Yeah, that goes to show the quality of people we've got up there.
Yeah, yeah. Well, I mean, you just look at that Yellen clip, right? And you think, oh my God.
And can you imagine if you, as a pilot, were to make decisions like that?
No.
Yeah.
Be bad.
Yeah, be very bad.
Bad things would happen.
Right. Anyway, so that's quite interesting to watch this space and see where it goes from here.
Yeah. So we'll see what happens in the next week or so. But things are getting interesting. It'll be interesting.
Yeah.
Now, so the next bank is looking like this has been on the cards for a while, but it's really taken a pummeling in the past week, is being Credit Suisse.
Yeah, that's in the European side of affairs. Yeah.
Yeah. Now they've been bailed out by the Swiss central bank, but it's only a bandage. That ain't gonna solve anything. And ironically, the Swiss central bank has lost, I think it was 140 billion last year. So I don't see that one lasting. And the problem with Credit Suisse is it is a very systemically important bank.
Yes.
So it's too big to fail. But the question is it too big to save? Okay, because the numbers involved when Credit Suisse are astronomical. And the EU, you haven't got that centralization of power you've got in the US, which allows them to come in and have this coffee over a weekend and just print trillions of dollars. There's going to be a lot of wrangling in the EU about who gets to pay for what when it comes to Credit Suisse. And it'll probably end up being a problem for the US, for the Federal Reserve to come in and deal with. But even then, the numbers are so astronomical. It's going to be fireworks.
I think so. I mean, here's a quick question for you. Don't know if you know the answer, but is the CS is obviously Swiss bank, isn't it? Does Swiss count as part of EU then for banking regulation, or does it stand alone?
Good point. I'm not sure. Switzerland's always been slightly odd relationship, hasn't it? It's kind of in and out of the EU.
Yeah.
I'm not sure.
Because even BNP and other European banks are going through a huge sell-off on their stocks, hasn't it? Because of their portfolios that they hold. And this is the interesting bit, because you've got these bonds in the US which are creating problems, which went from the return on the bonds went from 1% to 3% or 4%. What happens in the EU where the bonds were negative yielding to begin with?
Well, exactly, right. So the problem is potentially even worse in the EU.
Yeah, and the systemic effect is there. I was reading the other day, and there are lots. So India's been pushing this whole startup scene last few years, right? Lots of people, and the Prime Minister's been going around and saying everybody should start a business, do it, just you'll get funding, this, that. And a lot of people have successfully started these startups, and some of these actually, not some of these, quite a few of these, were banking with Silicon Valley Bank, because a lot of the startup businesses, SaaS, software as a service, or doing work with the US and what have you. So the ripple effects were felt all the way down to India, and I'm sure other countries as well. So
Yeah, and that's for a quote unquote relatively unimportant bank, right?
yeah, exactly. Well, it was important in that startup scene and tech
Yeah,
scene, but yeah,
but it's not a big
not like CS.
international.
Yeah, you're right. CS
No.
is huge.
Yeah. Yeah.
But I don't know. It'll be interesting to watch the space. I don't think so. The storm clouds have completely cleared from the horizon for the banks yet. I think this
No, I
might not be
don't.
the
No.
end.
No, I agree. So it'll be
So
interesting to watch.
yeah. I mean, my friend who I went for a walk the other day was saying same thing. He's saying, I can't believe Bitcoin, because he knows I talk about Bitcoin and what have you. And he's saying, I can't believe it's not 100K already, because this is exactly what it was built for.
This is your ex-Lehman friend.
Yeah. And he says it's exactly what it was built for. So I was like, yeah, good point. Shame,
No,
really. But it's still gone up, hasn't it?
Yeah,
It's
I don't
shown.
really agree with that. I just don't think Bitcoin to 100K in a week because a couple of regional banks have failed is a realistic scenario.
I think it's a flippant comment, but yeah, you get the gist. I mean, he was expecting a much bigger rally, but it has happened. I mean, it's
35%.
It's pretty spectacular. And I think, I'll be honest with you, it does give you peace of mind. I think, which is what having any exposure to Bitcoin is better than having none. You know, even if you buy like a few £100 or dollars worth of euros worth of Bitcoin and just putting it in a ledger or a Trezor in a cold wallet somewhere, it's better than having, at least you've got access to something, some capital when things freeze up.
Yeah, for sure.
So no, very good. It's definitely an interesting space to watch. I think we should look at Nick Carter's article as well. I think that'll be a good read.
Yeah. Okay. Yeah. Let's do that.
It sort of ties in nicely with what's going on, and he almost called it, didn't he?
He did. Yeah. Yeah. To be fair. Yeah. All right. Well, let's do that then.
Okay. Cool.
Next week.
What else do you want to talk about this week? Anything else interesting you want to talk about?
I think that's really the main story, isn't it? Everything's kind of revolving around the banking sector at the moment.
Yeah.
So no, I think that's all I've got.
Yeah, no, same here. I think it's just interesting. I wonder what this does to stable coins, because a lot of stable coins were based at Silicon Valley Bank, weren't they? I think Circle USDC had a huge deposit at SVB.
Yeah, so they've been bailed out, right? And I'm delighted for the people that had their money in it. I don't want to see anybody lose money, but I think it's a shame, because I think the whole, I'm doing air quotes, crypto industry would have been brought to its knees if Circle had lost its 3 billion and had gone down. I think I think a lot of people would have learned a lesson there about if you want self-custody, no counterparty risk, there is only one game in town. I don't think a lot of people have fully grasped that with stable coins yet. So it is what it is.
Yeah, well, the irony is it's sort of almost made Tether look like pristine collateral now, isn't it? Yeah. Everybody's moving to Tether, which was like considered to be the systemic risk. A bit like the USD then.
It was even trading above par, wasn't it, for a bit?
It was. Interesting. Okay, mate. I think that's about it from me as well. I can't think of what else we need to talk about.
Let's leave it there then.
Yeah, keep an eye on this space. We'll see if what happens the next week. I'm sure it's going to be an exciting one.
Cool. Thanks for listening.
Thank you all.